Hello everyone, I'm Pacchia and this is Bloomberg Law on Demand. We're taking another look at the mergers and acquisition space today with a special focus on India. I'm happy to say my guests are Valerie Demont and Jim Rosener. They're both partners at the law firm Pepper Hamilton, and they're based here in snowy New York City. So let's just jump right in. We did an event a couple weeks back about cross-border M&A with Chinese firms acquiring United States assets. What are we seeing from India? Are Indian companies similarly interested in coming to the United States and taking a look at assets?
Yes, we're seeing a very large amount of interest by Indian corporates in coming into the United States. In fact, the amount of investments into the United States by Indian companies has really grown exponentially. Mm-hmm. It's still a lot of small transactions, between $25 to $50 million range, constitutes still about 50% or more of the overall package of transactions. But we're starting to see a fair number of very large transactions in the several $100 million and a couple of $1 billion transactions that have taken place over the last couple of years, and we expect to see a lot more of that. And there's a number of reasons behind that growth and that interest.
And I think parallel to that, you're seeing capital being raised in the U.S. for investment there by Indian firms and Indian banks.
What's driving this trend? There could be a number of issues at play here. Is this about currency? Is this about gaining market access?
Well, it's about growth. I mean, India still has double-digit growth, and people want access to the growth. It's large needs for infrastructure, large needs for consumer goods, supplies, and between government tenders and demands of companies to expand and continue to meet the demand. They need both inbound resources and continued growth to support their GDP growth.
Right, and we're also seeing a lot of companies who come to the U.S. to acquire brand names, to acquire market share, to acquire technology. A significant amount of these Indian acquisitions in the U.S. are really in the IT and the outsourcing and the technology space. That's a big driver. Also, the fact that you have a lot of distressed assets in the U.S. and Indian corporates are really value-focused entities, and so they, now they're. A lot of the U.S. assets have come to a price point which makes it an attractive acquisition for Indian companies. The other thing is a lot of Indian companies have a lot of cash. They're cash-rich companies, so in an environment where debt is still difficult to obtain, although it's much better than it has been, it gives them an advantage over other purchasers.
I want to talk for a moment about valuations. Are we starting to see a directional trend? Are valuations increasing as this cycle develops, or is this something that's still unclear at this point?
I'm not sure there's enough visibility to point to a particular trend on a multiple. Certainly the public markets in India tend to gyrate to very high valuations. I think somebody said 70 to 75 times earnings, which is obviously explosive and 2 or 3 times what a high rate would be here. But on the private market, there's just not enough visibility to point to any trends. But presumably it's similar.
And in the Indian context, what I've seen a lot is a big gap in valuation between the buyer's expectations and the seller's expectations. Indian buyers are very aggressive on price. I mentioned earlier that values are now closer to the point where they're willing to do deals, but I still see a lot of deals that fall apart over valuation.
What about structure? We've spoken a lot about how a lot of the deals in the last, let's say, 6 to 12 months have been all cash. Are we seeing a lot of all cash deals in this part of the M&A space as well?
For a lot of the transactions that are in the in the $25 to $50 million range, it's still all cash, no question about it. For the larger deals, there's no choice. Even those cash-rich companies need to go and incur debt. There is a traditional aversion by Indian corporates to the incurrence of debt. It's not part of the culture. It's also very difficult from a regulatory standpoint to incur debt. Debt is highly regulated in India. On the other hand, you do have Indian banks which are prepared to lend, which have not been as affected by the economic downturn as the U.S. banks. So there is lending capability in India, and so these Indian corporates, particularly for the large deal, the billion-dollar deals, are all funded with a piece of debt and, of course, a large amount of cash.
Jim, if we could talk a little bit about the particular issues that face Indian purchasers when they come over to the United States. How do Indian firms do under CFIUS review? We've spoken about how this can be something of a troublesome process for foreign purchasers.
It really depends on the industry. It's obviously wise to do an application under the CFIUS. To the extent it's a defense industry, nuclear power or the like, it will get the same scrutiny as most.
There seems to be less politicization of deals when Indian firms are involved. Is that accurate?
To a degree. There's still going to be a review. It's probably not going to get to a second review. I think some of the Chinese firms have had more trouble, most notably the acidic attempt to get take over Chevron when that was blocked by the CFIUS panel. But I think there's fewer second reviews.
When deals go bad, it's not always a happy marriage.
Right.
What happens when an Indian purchaser is involved in a deal that goes poorly? It has been said, and it's the opinion of some, that the Indian court system moves at a different pace than many people are used to in other parts of the world.
Well, just as an example, we started an arbitration about 15 months ago, and it's only now that we're getting to the point where we're setting the schedule with the panel. Arbitration is much faster than the Indian courts. The Indian courts tend to move very, very slowly, depending on the state, depending on the court, and your counsel can determine whether it's a 15, 18-year process or whether it's an eternal process or something that gets wrapped up fairly quickly. And one of the biggest strategies of Indian companies when they're in a dispute is to try and get control of the process through litigation. So what we've been advising clients, to the extent that it helps, is to have an arbitration provision, preferably an institutional arbitration provision that has more westernized standards, either in India, where they have the LCIA India Court, which is the first Indian institution of any size and recognition to be formed, and that was formed in 2008. And hopefully have at least one, if not more, Western arbitrators on the panel, and you can provide for that contractually.
Interesting. Now, Valerie, another issue that's been brought up, I've been talking to the editors of the Bloomberg Law report for mergers and acquisitions, and they raised the issue of the Indian government's stance on taxation. There has been some scrutiny applied to previously closed mergers in that country. What's happening there? What's behind that?
Yeah, what's going on is there's a very aggressive drive by the Indian tax authorities to capture revenue when they believe that there's an excess with India. So, for instance, one of the most watched cases that is going on right now before the Indian courts is the case involving Vodafone, where Vodafone made a significant acquisition of assets, which were India-based assets, but the acquisition was structured through the purchase of stock of a Cayman Islands entity. The Cayman Islands does not have a double tax avoidance treaty with India, and the tax authorities took the position that this transaction, even though it took place offshore between two non-Indian companies through the stock of an offshore company, was really a transaction that was subject to tax in India. Therefore, under the Indian laws, Vodafone, as the buyer, should have withheld capital gains tax on the amount, and here you're talking $2.6 billion of withholdings. The total purchase price that was paid was in excess of $11 billion. So you're looking at a very large amount. The case is currently on appeal. The High Court in India ruled against Vodafone. It's now being appealed, and the Supreme Court is expected to make a decision later in February. But what this means is, in terms of the impact for ongoing M&A, based on that and the success in front of the High Court, the Indian tax authorities have then issued basically notices against a number of foreign companies that have closed M&A transactions.
So this is happening
in similar
enough
situations.
To mark a trend.
Hundreds. You're talking about hundreds of companies that have received notices that they should have withheld capital
Will
gains
this kill
tax.
the desire to do deals?
Well, it depends. One of the things that's unclear is whether it's because you had an Indian business owned by a holding company that was owned by another holding company, and there was no other business for those holding companies other than holding the India company. The Indian tax authority said, well, it's just like buying the Indian company just through the shell companies above them. What's some of the discussion going on now is whether that would apply to a company that's owned by another operating company that's owned by another company whose shares are purchased. And just the mere presence of a permanent establishment in India, whether that would cause at least the Indian value of the transaction to be taxable in India? And if so, how do you allocate the purchase price consideration at the top level? And virtually every inbound investment in India has been structured through a Cayman or a Mauritius, or some kind of structure that has a double tax avoidance treaty with the United States to make those more efficient. And if they're starting to disregard that structure, well, as to the existing entities, the problem becomes if you've done a transaction and you can't withhold a tax because of your contract that's in place, or you haven't withheld the tax and it's being reviewed, it's the buyer who ends up getting stuck paying the tax because it's its responsibility to withhold it. And I just think it'll be reflected in the structures of deals that people know that there's a capital gains. When they make investments, they'll take that into account in making those investments.
And the point is that there are ways in India to deal with this issue. You can go before the tax authorities before you close your deal and trying to get an answer from them up front as to whether or not you're going to have to be subject to tax. Assuming you have to tax your deal, then your question is going to be, how do I get a credit in my own jurisdiction? Mm-hmm. So you can plan this, but I think for everybody who's doing a deal with India, they have to assume that they are going to have to pay taxes to the Indian government, even if they structure through a treaty jurisdiction, because there's a lot of uncertainty there as well. So it's better to be conservative in this space.
Just in closing here, we're a little short on time. The macro-political landscape that exists between the United States and India, in your opinion, is it conducive to seeing an increase in the deal flow in 2011? Are we expecting a lot more activity?
I think there's demand. I think there's an increased deal flow. I think people are looking to American companies to help them with the myriad tenders that are going on in India for business to the government. Partnerships with Indian companies need to have Indian-based businesses producing those products. Yes, I do think that that's going to happen.
Absolutely, I agree with that.
All right. Well, guys, thanks so much for coming in today.
Sure.
Appreciate
Great.
it.
Thank you.
That's Valerie Demont and Jim Rosener. They're both partners at Pepper Hamilton, and they're based here in New York City. If you'd like to learn more about the issues we just discussed today, please check out our offerings on BloombergLaw.com and, of course, on the Bloomberg Terminal. I'm Pacchia. Thanks for watching.